Welcome everybody. It's great to have you all here today. Pitcher Partners is delighted to host you on a topic that, based on people's response to the invite and to the attendance today, is obviously of interest and input to a number of you. Just to tell you, for those of you who aren't as familiar with Pitcher Partners, to tell you a little bit about us. Pitcher Partners is a national association of independent firms and also a member of Baker Tilly internationally. Melbourne is the national headquarters of the Pitcher Partners Association, and we have about 650 people in this office here. We've got a very strong focus on the middle market, and that includes fast growth businesses, and nowadays increasingly that involves businesses that are either tech businesses or tech enabled in some way. We have quite a number of clients in the fintech space across crowdfunding, digital payments, peer-to-peer lending, and robo-investing as well. And as an example as well, our Atlanta affiliate firm has BitPay as one of its fastest growing clients. And for those of you who don't know BitPay, it's one of the largest Bitcoin payment processors for merchants, based in the US, but it's a global business now. And given our heritage as a firm helping small companies become big, we're interested in fintech because it goes right to the core of how business is done. So we also want to extend a welcome to those joining us online today via Periscope. So we may have some questions coming through. We'll try and get to as many as we can. I'm joined today by Alexis, who's a partner in the tax consulting division with over 19 years experience. And Alexis leads the Pitcher Partners National Association Tax Technical Division and has been involved quite heavily in consultations with government on legislation, recently including the crowdfunding legislation. And he'll be talking some more about that. But Alexis was also recently recognised as a Thought Leader of the Year at a recent Accountants Daily Awards, and it'd be great to, as we hear more about Alexis' views on yours, you'll see why. As for myself, I'm part of the consulting group at Pitcher Partners. I've got a particular interest and focus on digital innovation and digital strategy, and I've got a background of more than 15 years in e-commerce and in tech startups, and so this intersection of how business is enabled by technology is of particular interest. I've also been quite active in the Melbourne Bitcoin community and blockchain technology, so really great to see the response to today. And we work very closely with Connecticut, and we're joined by them. And I might just introduce Paul to tell us a little bit about Connecticut.
Right. Thanks, Cecile. So we're a law firm, and our name is Holly Nethercoat, and also a compliance and training business called Compact. And most of our clients are Australian financial services licensees, or credit licensees, or otherwise regulated by the anti-money laundering legislation. So that's a big focus of our firm. And I guess today we're talking about fintech. What is fintech? It's a bit of a buzzword, but it sort of refers to a few different industries. And so we've got a few different industries in this room, which we'll hear from you quite briefly in a second, just to get a feel for who's in the room. We define it as the industries that we're covering: peer-to-peer lending, crowdfunding, robo-investing, robo-advising, those kind of automated businesses, and digital currency. So what we'll do in a moment is we'll go around the room, but before we do that, I'll just quickly introduce some of our staff as well. So David, sitting next to me, is one of our partners who specialises in managed funds, superannuation, a lot of these fintech industries is very connected to the managed funds space. And so David will be talking about a few of these things a bit later. We've also got Megan McMullen, and she's been with us for a few years before working at ASIC in licensing, and Megan has done a lot of work across all of these categories of fintech that we're talking about today. So she'll be talking about various crowdfunding regulatory changes that's happening, and also Megan is one of the authors of our monthly regulatory updates. So we'll talk about, we've got an agenda of just a couple of things today. If any of you have questions, we really want this to be forum-y, so you can just sort of jump in with a question once we start talking through these topics. I don't think forum is a word, but we'll try anyway. And so let's do that once the agenda is pretty light. Once we work out who's in the room, we'll sort of tailor what we're going to talk about. But debanking for digital currency providers is a really big issue at the moment. We're also talking about licensing for various fintech types of businesses, and we're talking about crowdfunding. They're the three broad topics. And so what I was wondering is if we just went around the room, if you could just tell us your first name and the industry you're in. Some of these businesses aren't yet live to market, so you might just say the robo or automated advice. So if we could just do that, then we'll get a feel for what industries we have in the room. Just one thing I've got to say about myself is I'm just chairing the forum mainly, and I'll talk about debanking if it's relevant to you guys. One of my roles is the chair of the Anti-Money Laundering Committee for the Australian Digital Currency and Commerce Association, so we're doing quite a lot of work in that space for the digital currency providers. So anyway, if we just quickly go around the room, you sir?
Rob Mackay, Pitcher Partners.
Sorry, so we have a at the office.
Right, so the lending partners.
Tim Everco, partner of Paul and David.
Fazal from Flexi Wallet. We provide payment solutions and we specifically look at the remittance industry.
Okay.
John Maney from Tree Pillars. We're setting up a marketplace lender for terminals for SMEs.
Okay, so peer-to-peer lending?
Thank you. Depends for it.
Afternoon, everyone. I'm Alan Fitzgerald, an independent consultant assisting corporates with software services.
Thank you.
We have Chief, senior consultant for Pitcher Partners, and specializing in software development.
Moresh, founder at Estate Baron Property Crowdfunding.
Thank you. So managed funds, crowdfunding.
John McCarthy from Pitcher Partners, Director of the Corporate Secretary Division.
Thanks, John.
Stephen, supporting Moneyplace, peer-to-peer lending and managed fund.
Okay, thank you.
Thank you. We're in the robo space.
Great, thank you.
Melanie Nguyen, I'm from Moneyplace, peer-to-peer lending.
Lily Steiner, American Business Gateway, an Aussie living over in the States for over 20 years and involved in a number of different technologies, and in particular actually a new Bitcoin company that is going to bring it out into the general space.
Okay, right.
Tamas Zabo, I'm head of Asia Pacific for IG Markets. I also set up the CFD Forum, which is an industry forum affiliated with ASIC, so I've got some experience in regulatory stuff.
Right. Thanks, Tomas.
Grant Holly, partner of Tim, David, and Paul.
Oh, Grant.
Anthony Wilkinson for Property Shares, crowdfunding using MIS.
Peter Payne, business referral, specialising on IT companies.
Okay, so what sector?
Well, January.
So across a number of them.
I'm sorry?
You're across a number of these sectors, are you?
Yes.
All right, thank you.
Shelley Trong, I'm a Fintech angel investor, mainly portfolio in the US.
Okay, so angel investing. Okay, thanks.
Peter Christone from Navani, we own Flexi Wallet.
So you should watch what you say because this will be a film.
So I'm in charge of our Navani Ventures portfolio. So we're a technology provider to fintechs. So we provide a portfolio, a technology platform that means they don't have to spend their VC on building stuff so core PD, so via APIs as well.
Thank you. Right.
Scott Price with Property Shares, peer-to-peer real estate investing.
Thank you.
Stuart Stoyan, Moneyplace, peer-to-peer lending.
Craig Simmons, Clover, robo advice. Sergio, Clover as well.
Great.
Peter Lightfoot, on with Partners, Financial Advisors.
Harry Tremaine, CEO of Clover.
Great.
Matt Fletcher, I'm Managing Director of Melbourne Securities Corporation. We're a professional trustee firm, and we give, where we can, outsource access to financial services licensing, Australian credit licensing, employment author status.
So a lot of your clients are in this room, Matt. There's a few. Great, thanks, Matt.
I might just mention one. Have we missed anyone going around the? I think we're just having heard the different businesses. There are some stats here. So in Australia, Fintech is currently worth about $49 billion, estimated to grow to 121 by 2020. Payments accounts for the majority of this, about 48 billion of the 49 at the moment. But the highest growth areas are business finance and consumer finance. So they're growing at a rate of 290% expected over the next couple of years. So it's and in the Melbourne space, there's a survey that's being run at the moment that I encourage you to check out at fintech.com, which I think Stuart are involved with. So there are some stats on the Melbourne fintech community there, but about a third are in payments and billing, and 42% are lending and asset management. So
great.
Reflected in the mix.
It is reflected in the mix, I think. So for those of you that are watching live, I guess it's mainly peer-to-peer lending and credit and managed funds and then robo. Is anybody here representing sort of digital currency interests? That's it. Sort of one, maybe a few people following us. Okay. Well, before we get into that, I'm just going to keep it really high level because there's not many people represented on that particular agenda item. But just one ground rule, I guess, is if you're talking about something, if it's in the public forum, you can name it, but if it's not, then it'd be best not to use names that can be used to identify various businesses. So that's probably all I needed to say there. Well, the first item is this idea of debanking. For those of you that don't know, some digital technologies like Bitcoin and other types of digital currency can facilitate cross-border transfers. That's resulted in a significant concern from Australian banks because they want to know who their clients are and where their clients are sending money on behalf of other people. So what's happened is globally in the US, there's been big fines levied on US banks for various criminal activity, some of which is financing terrorism, some of which is simple money laundering. US banks have therefore said to Australian banks, we're going to restrict certain currencies if you don't debank certain the sector, really. And so we've seen in the last 2 years debanking of money remitters. So in the last couple of months, the banks in Australia have started closing down accounts for digital currency providers, and so the association and other lobby groups are working to try and create some sort of code of practice, some sort of minimum standards that the banks would accept to manage and then carry, I guess, the risk associated with banking a digital currency provider. To give you the headlines about where that's at right now, we've had one-on-one talks with a number of the banks, and the banks tell us that they don't have a zero appetite for digital currency. Most banks want to embrace new technology. They want to get in with businesses like yours and the businesses you represent early in the growth curve. It's just a matter of having a really robust compliance regime, using systems that the bank recognises around electronic digital verification for KYC, know your client. If you're using the same digital verification provider as your bank, then they're probably going to like that. Knowing where the money's going, knowing that the money isn't going, you're not transferring money to sanctioned countries, you're not somehow transferring value through a digital currency or sort of a non-bank means to Syria and those kind of places. There's some of the concerns that the banks have told us about. So there's a code of practice being worked on. The industry associations are the places to go for the latest, or the Australian Digital Currency and Commerce Association for digital currency. So does anybody have any questions? I'm just conscious that we've got so many people in the room. I don't want to spend your time if you don't really have a burning question about that issue.
It seems that Bitcoin is being accepted by more and more people, so it's an option in the same way as credit cards are an option, and so banks sort of have to accept it. Is it just the larger transactions that they're having a problem with, or?
Well, I think allowing payment by Bitcoin is not, that those people aren't being debanked. It's more the providers of that merchant facility, for example, they would be targeted because they're operating a network. So if, as a law firm, we agree to accept payment of our legal fees by Bitcoin, I don't think the banks are targeting us as a problem, although there's still money laundering risk that we would have to manage.
Well, let's talk later, because
Yeah. So we're seeing some businesses having to basically stop trading until they can find a bank, and then we're seeing some businesses continue their banking relationship, but to do that they have to basically have high standards around some of these regulatory issues.
Well, the question I might ask is to what degree are you finding that some of these issues are arising because the banks are trying to apply laws that just didn't contemplate the business models or the options that things like Bitcoin have?
I think that's part of the problem. At the moment, digital currencies like Bitcoin in Australia are not considered caught by the anti-money laundering legislation. So AUSTRAC has said it will accept reports. AUSTRAC is the anti-money laundering regulator, and it has allowed businesses to opt in, and certainly to opt in to the anti-money laundering regulatory regime. And certainly that causes heaps of legal problems, but it's a start. And if you can, if these businesses can show the banks that they are actually trying to opt in, trying to meet these safe harbour requirements that would apply to money remitters, for example, then that's a good. That's what the banks want to be seeing.
So focus on process and compliance to the best degree you can if you're a startup in that space.
Yeah, that's right. And before doing your first transaction, having it set up is good rule of thumb too. All right, any other questions, or are we happy to move on to our next topic?
Just one call. For your clients that are looking at that sort of space, the non-cash market, what is your licensing advice? Because I notice a lot of these Bitcoin providers in particular don't generally have licensing. Are these non-cash payment products? Are they making a market? What is generally your advice?
Well, we've done some legal advice for some of our Bitcoin clients, and we came out really early on and said that in our view Bitcoin itself is not a financial product, and ASIC has come out with that view as well. I think the facilities around Bitcoin, it might be, obviously if you wrap Bitcoin into it, well, if you offer a CFD like IG Markets that derives its value from a Bitcoin, that's a derivative. We think some of the merchant facilities around Bitcoin are probably non-cash payment facilities. There's lots of exemptions in Australian law around what is not a non-cash payment facility, and sometimes those exemptions don't apply. So that's one of the authorisations. Megan, would you add anything to that? I mean, we've looked at this question a few times.
Yeah, we have. I think it's, again, a space where perhaps there's a wide variety of interpretation, and also a lot of people getting out there from, I suppose, maybe more of a tech background, not really looking into the question of regulation very deeply, and so thinking, oh yeah, Bitcoin's not a financial product, we're fine, we don't come within ASIC's jurisdiction at all. I think we've found that not to be the case in quite a few cases. And just because I suppose the Bitcoin itself isn't regulated doesn't mean that the rest of the business isn't.
Just one point on that. The Australian legal position at the moment is if you use Bitcoins to buy something, it's like you're buying it with gold bars or something like that, just regarded as a commodity. And it's all very 20th century and everything. I think it's an area that's right for, there'll be a special law created for Bitcoins eventually. Just a question of when and what it looks like. And I think the drivers for that will come from overseas and they won't develop in Australia. It will tend to be a follow-up in that regard. But at the moment, it's pretty much, you're not a financial product, you don't worry about it.
There's been some early reports out of the Financial Action Task Force, which is one of the global anti-money laundering bodies, that they view Bitcoin as much more akin to a foreign currency than merely a commodity, and they're agitating for national regulators to regulate it in such a way. If Bitcoin was found to be a currency, then that would immediately bring it within ASIC's licensing regime and make it a financial product. But the pace of change with those sorts of recommendations is fairly slow. FATF will make these recommendations, and then it's got to filter down to the individual countries, and countries can interpret those differently. So, yeah, I don't think it's anything that's going to come to consensus in the short term.
And just to explain further, the Financial Action Task Force, which sets anti-money laundering legislation, has principles which are then rolled out into different countries. And so some countries have licences, like a New York is a big licence. There's discussions in other countries, and some of the other countries are starting to roll out licensing as well. So,
yeah, and it could be that the great value of Bitcoin is the blockchain technology, not necessarily the payments themselves. I think that's an area where there's going to be a lot of development in the next few years.
Great question. Yeah. So far, everything seems to be revolving around Bitcoins. But what about the alternate cryptocurrencies, like, for example, Vericoin, Goldman Sachs, Ethereum, and etc.? Does that actually encompass? Does Bitcoin actually encompass all the alternative cryptocurrencies, or will they have to be treated separately?
They each have to be treated separately from a legal perspective, separately. So some are asset-backed, some are completely derive their value from this decentralised cryptocurrency formula, decentralised, also like a blockchain. So there's lots of variants, I think, with the blockchain. And so the asset-backed ones are totally different creatures.
Right, so it's going to cost a lot more headaches from a legislative point of view in the future?
The government will have to look at each one, I guess. So
I was going to say that the reality is when the language used around the regulation typically is around digital currencies. In practice, 95% of the value of digital currencies is held within Bitcoin currently. So when they're thinking about the legislation, they're looking at that as the basis or foundation. Things like Ethereum, really, it's more linked to how the blockchain can be used to facilitate things. So it really starts to go into more the areas of smart contracts and how they're treated. It definitely affects robo-investing as well. But yeah, a distinct framework that
Well, I reckon this is a good time to move on to the next topic. The next topic that we were going to talk about was crowdfunding. So there's been a few changes in the law in that area, and Megan, if you're happy to give us a bit of a summary and go from here.
Sure. Yeah, the government released on Friday its legislation to essentially create a brand new class of financial product, which will enable crowdsourced equity funding. And I suppose it's a key distinction to draw initially. When people talk about crowdfunding, there's a whole range of different things that fall within that banner. And I suppose with a lot of these sort of fintech buzzwords, some people are very keen to apply the label. So the main areas of crowdfunding that we see are crowdfunded debt, certainly a whole range of people putting money together and then people borrowing that out, and then crowdfunded equity, where you can issue shares or equity in your company to a whole range of very small investors, as opposed to a more traditional listing where you tend to have to go after larger investors to make such raising economically viable. So the latest legislation covers off on crowdsourced equity funding. So there is now plans, and I suppose it is just legislation before Parliament, so this is all subject to change. But the intention is to create a new regime that will allow the raising of equity from a large number of small investors. The mechanisms by which that is occurring is that there will be a new type of financial product that people have to be licensed for, and that license will have to be obtained by the entities that are essentially running the crowdsourced equity funding platforms. So the normally websites and those tech platforms that will allow the investors and companies to come together. The legislation will give relief to companies seeking to raise equity from some of the disclosure requirements. So one of the biggest costs often and headaches in doing a listing is getting your prospectus in order and sending that out. So there is relief for companies utilising this model from those sorts of disclosures. However, that comes with a fair few strings attached. Companies seeking to obtain this sort of crowdsourced funding are limited as to how much they can raise at a certain period. They have to be below a certain size. They must be public companies below a certain size, so proprietary companies won't be able to access that relief. And individual investors will be limited as to the amount that they can put into a crowdsourced investment, which is, I think, intended to, there's sort of some of the consumer protection benefits that ASIC's seeks to put in, and the provider of the platform will essentially be the entity responsible for a large part of the monitoring and reporting back to the regulators for providing certain disclosure documents and various other obligations. So yeah, I think we're waiting to see to what extent the legislation goes through unchanged, or whether there'll be any significant changes from the Senate. Alexis has been pretty close to most of this.
So Alexis, do you have any comment on timing?
Yeah, so I mean, it is interesting. I mean, the legislation probably isn't the most broadest piece of legislation to the crowd source equity funding, but there's some interesting aspects with respect to it from a structuring tax perspective that people probably need or would like to be aware of. At the moment, reading through legislation, the securities, terms of securities, they'll be listed in regulations in terms of which ones may otherwise be acceptable. And from a tax perspective, you can have equity, which is debt, effectively by issuing preference shares that are redeemable. So there's going to be a question of how broad they go into these types of funding mechanisms, whether you could effectively get debt funding into this regime by using redeemable preference shares and expand this crowdsourced equity funding provisions to be closer to what the peer-to-peer platforms are doing at the moment by having those different instruments rather than just having ordinary equity capital. So it'll be interesting to see where that aspect goes to. The other thing that's obviously interesting from a tax perspective is the announcement that's supposed to come out today on the 3-year capital gains tax exemption for investors going into those platforms on the fintech side and holding on the shares, and how that's going to also interact with these provisions. Obviously, that they're trying to encourage VC into this space, but then you'll have that exemption coupled with the ESBCLP regime at the moment, and how that interacts. And lastly, which we'll touch on a little bit later, we've had the Managed Investment Trust regime that was released from a tax perspective. And although some of the crowdsourced equity funding rules that have come out aren't the greatest in terms of, you've got to go public and lodge accounts and etc. The other option is obviously setting up a managed investment scheme under the new provisions that came out last week, which they've created the new class rules in there, which is effectively to allow a managed investment scheme to be bifurcated into a number of classes and effectively get investor to asset relationships from a managed investment trust scheme instead, and having more open to cover private companies and other things going through that type of regime. So it's a lot of things bubbling in at the moment around the tax side of things that are going to be very interesting in terms of how they're going to play out over the next 6 months.
I think the other big thing about the new financial products and the requirement to be licensed that's contained in this new legislation is that I think ASIC's going to need to release a fair bit of guidance about how they're going to administer that new change. So far, when we've seen new products added to the licensing regime and added to the Corporations Act, generally they're products that have already existed. So margin lending came in that regime a few years ago, and it was fairly easy for businesses to be able to go to ASIC during the transition period and say, look, I'm a financial planner, I've been helping my clients dealing in margin loans and advising on margin loans for the last 5 years, and so therefore now it needs to be licensed, I should get a license. The financial services licensing regime is very much built on proving to ASIC that you have existing experience in the type of business that you want to be licensed for. That's how the entire system is set up, and that's a whole nother challenge for fintech businesses. But in this particular case, where there's a financial service being created that isn't widespread, doesn't have a long history, I think it would be impossible for any person to meet ASIC's current requirements and say, look, I've got 3 years experience working at a crowdsourced equity funding platform. There's just, it's not possible. The technology hasn't really been in place that long. And so it's going to force ASIC, I think, to consider the types of issues that fintech businesses are seeing across a wide range of sectors, where the challenge of trying to fit within the existing regime that is very much based on your historical experience when you're looking at brand new technologies and products and businesses and entire industries. So I think ASIC's going to have to come up with some new ways to manage that transition, and it'll be really interesting to see what they pop up with, and whether, having come to those principles of how they're going to administer the crowdsourced equity funding regulation, whether they're going to use have those principles inform how they deal with other fintech industries.
Alexis, I know we've been discussing the question of how useful this thing's actually going to be, and there's a big question mark there. It seems like they're trying to make venture capital more accessible. It's not coming up with a peer-to-peer solution for anything, and it just seems fairly narrow and constrained. Is that your thinking?
Yeah, so I mean, in terms of when we were involved with the draft consultation when it got released, and we did make a submission saying we think it was going to be very limiting, and a lot of the press that came out suggested that as well. But due to, I guess, some of the parameters they're putting around it, in terms of limitations that it's gone through, I think they've probably gone on the conservative side in terms of what they're allowing to come in the regime. I mean, if you look at it, and it's $5 million capital raising limitation, but then you look at the size of the company, it's also $5 million size of the company. You establish for $10 a share capital, first day you can't even hit $5 million on your first raising. So for some reason they've gone very heavy on the regulation. And then you go, if you raise more than $1 million, you've got to go full-blown audit for your financial statements. That's okay if you're a fintech looking to bring in startup capital basically as a company, and then use that to kick off, and then you're going to get a list, or you're going to go public anyway. So then you say, okay, what's the difference? But it is, when you think about it, you're going to have all the compliance costs from an accounting and tax perspective and other things if you're going to go and just be a public company looking to raise capital. So there's no real reason they need to do that. They could have gone with what we call for audit purposes. They could have gone with a regime where at 31 December most public companies get a review rather than an audit. They could have said you could be private and have a review. They could have said you could be private and you could breach the 50 shareholder test. We'll leave you alone as long as it's through crowdsourced equity funding. They could have done a lot of things to introduce more people to the regime. Obviously, they're worried about consumer protection more than the applicability to middle market.
On the consumer protection, what is the argument put forward on capping individual investors, other than just an arbitrary amount?
In terms of the dollars amount, so they had the two options, which is $2,500 under one option and the $10,000 under the other option. They're basically saying
quite easy to jump across the river and one of my life savings at the casino where I can go off and invest in cheap speculative mining stocks or trick myself to inebriate, whatever. But why is it that the lovely Kelly O'Dwyer has just decided to beat up on this space so hard? Stand up for you.
It's almost an antithesis of what crowdfunding is all about. It started off as an exchange for products for an investment, and then people really wanted to get in on the upside and get some equity in the company. But what you're describing is like way government overkill.
And the $10,000 investment limit. But that being said, though, they came back on all the other models that were that have been used in other jurisdictions have either a $2,500 limit per investor or $10,000. So the government isn't, I guess, unique in this situation where they're capping investors, and maybe they are going overkill, and hopefully over time maybe they'll deregulate that aspect, and maybe they want to go off on soft. I mean, I guess if you go back and you say from an industry perspective, do you want to have something that happens on a large scale and the whole industry can collapse by way of regulation afterwards? And so maybe going in
light at the start might be okay, but it's just a question of degree, and I think they've gone overboard in terms of regulation.
Have you sat in on the discussions that have been going, or are you reporting the reports?
So my involvement's been in the consultation phase from the draft discussion papers to legislation. So we would be provided with copies of what they're intending to do, and then we make submissions and have conversations.
Would there be room for something that called for a even lower amount than 2,500 that wasn't regulated at all, that allowed people, regular people who wanted to throw in some money to be part of a large company that's growing? Is that even a possibility in what's being discussed?
In terms of what's being discussed, I don't see that at the moment, but...
Could you shove it in there next time?
we did put a lot of things in submissions, but I mean, others might want to comment.
It doesn't really work at the micro level even with this model, and I think that's the problem, that if you want to go around raising $250 off everyone, just
no, but it depends on the perspective you're looking from. I'm looking from the perspective of somebody who's working on a job that, you know, would never raise, you know, have even $10,000 or $20,000 to invest, but they might have $1,000 that they are able to just put into a company that they like, and without all the heavy government regulations, as the gentleman over there said, you can go to the casino or anywhere else and do other things with your money as well. Why does this then? Why does that opportunity of greater growth have to be?
I don't think in any of the legislation it says that you can't invest $100 if the platform which is offered is willing to do the administrative work. The only thing which is mentioned about $10,000 over here is you cannot invest more than $10,000 in one particular issuer. Okay, so what that means is if you want to invest more than $10,000, sure, go ahead, but try to distribute it across a few different issuers. I think that's a reasonable limit because that in turn forces you to some extent to distribute your investments across a few different issuers, and by any means it really does not prevent if anybody.
My issue is more in the regulation that's going to, and requirements that come with whatever size investment that you make, whereas it's, you know, before crowdsourcing started that you received a product, so you didn't receive money, understood, but now that you should be able to receive money if you pick the right product without having to jump through all the hoops, be it on your taxation forms or anywhere else. You just declare it as an income, it's an income, and it's just treated as such.
Look, I mean, it's probably doubtful legislation will get a lot better than what it is, but that being said, there's still opportunities we see on what they've released, because it's obviously a platform that currently it isn't otherwise available unless you go through the current acts of exemption. So if you look at it, they do offer a platform, an intermediary platform, so there will be opportunities for people in the fintech space to create a platform and have that available for people to come on in terms of investors and the underlying product. Yes, it will be limited in terms of what the underlying product would be, but there'll also be opportunities around marketing, the right people coming in. So if you are an investee company, from our perspective, we see the fintech sort of startup companies being the key parties looking for funding under this, because it's the first 5 years that you're exempt from audit if you raise less than $1 million. So obviously, if you're in the first 5 years, that you're not going to have an audit requirement. If you're looking for that first $1 million or $2 million of funding to get your business and get all your operating costs up, you know, all paid for, so you can get your business up and running, and then you can go more publicly to get more public raising, it's probably ideal for those type of entities. So if you start targeting the right areas, you can obviously get a product that might otherwise work.
So the question of the audits, does it mean that if you establish a public company today and you raise only less than 1 million,
yes,
you don't have to do audits for 5 years?
Sorry?
So I think the question is, if you raise $900,000 right now,
yes,
do you not have to
there's no audit requirement until you raise the $1 million, that's correct.
Is it for year one, or is it till up to 5 years? Or
so the first 5 years, it's $1 million raising at any point in time, and then after 5 years, if you only raise $10,000 after 5 years, you need to be audited. So we're saying if you're a small business milk bar operator and you're going to raise $20,000, you're not going to go use this because you're going to start doing public accounts. So it's not. So when you look at it, it's not going to be that as your target market that's going to try to come into this regime.
The other thing about, it's a bit disappointing about it, is they've gone with the preferred platform of the company. So So these rules don't apply to managed investment schemes. And because you've got a company, you've got shareholders out there, and you've got these day-to-day control issues too, that theoretically all your investors could, start appointing their own directors and all that sort of stuff into the company. So it's disappointing they didn't provide any rules for managed investment schemes either. So that's maybe something for the future.
All right. Before we move on to the next topic, does anybody who hasn't said anything yet have a question?
I was just going to ask, how does our experience at the moment compare with, say, New Zealand, who I believe is a little bit more progressed? Are they on the same path, or are they more liberal with their approach?
Well, I think one of the reasons the government's doing this legislation is because New Zealand's ahead of us, and they don't like that. It could be as simple as that. The model's pretty much the same as New Zealand, as I understand. A few other jurisdictions, Canada, I think, has got a similar regime. So it's hardly Australia pushing itself to the edge of innovation on this. It's really following the steps of others. I can't comment specifically on the New Zealand model.
All right. Well, in that case, I think this is a good time to move on to the next topic, and that's this idea of licensing and fintech. And the main discussion there is the two business models that are caught by licensing, peer-to-peer lending in most of the situations, and this idea of robo-advice. So both pitches and I need to get up for those sectors, and so we're starting to see, I guess we're starting to see some developments in that space. So maybe, David, do you want to kick us off on that?
Yeah, I'll start off. As Paul said, it's really an issue, most peer-to-peer and robo-advising investing. Bitcoin's not a problem. It's not a financial product, don't need a license. And with crowdsourced equity funding, with the new rules, there will be a new financial product called the crowdsourced fund intermediary, which Megan mentioned. I'll have to watch the space and see how that eventuates when the legislation's passed. So for robo-advising and for peer-to-peer, you pretty much are providing a financial service. Therefore, you need to be holder of an Australian financial service licence to operate that service. And for peer-to-peer lending, you also get hit by the credit side of things as well. So you need a credit licence to actually lend the money. There are rules that say you don't need a licence if you're an authorised representative of another licensee. ASIC is really unhappy with people setting up businesses as ARs, and they've come out recently and actually fined a provider for doing it because the authorisation wasn't wide enough in the first place. The other issue, they don't like if you're a product issuer, they don't think you can issue products as an authorised representative, and that's pretty much the view that Holly Nethercombe takes as well. To be an authorised representative, you're technically providing services on behalf of your licensee, you're not providing services on your own pad.
Sorry, can I ask a question there? But if the licensee gives you the same authorisations as they have under their licence, there's no problem, is there?
Well, ASIC says it doesn't allow you to issue.
For issuing.
Yeah, issuing is a
If you've
problem.
got issuing the licence and you give someone that full authority, can't they?
No, that's the view that ASIC takes. That's what you can't do because you act on behalf of the licensee. So all you can do is issue their product. You can't issue your own product on behalf of the licensee. This has never been tested in court, and there's a lot of people actually do that. And it'll be interesting to see where ASIC takes a really hard line or maybe tries a test case, but they're pretty much, if you come to their attention with an AR model, I'm pretty sure they'll come in and
Does that include?
it's really hard.
Does that include the licensee actually stepping up, not just being a credit, but also actually being the trustee inside if there's an MIS?
MIS is alright in the structure, so the licensee is the product issuer, and then you set up other party as an investment manager or something like that to devise the RE. So that's quite a common structure.
What about the intermediary authorisation?
Yeah, there's one other way of doing it, which is, as Paul said, the intermediary authorisation. ASIC doesn't like this one either. They think it's been abused. It was originally designed as a bit of an insurance thing to allow insurance brokers to actually issue insurance policies without having to trunk off to the AXA head office or the AMP head office and get the policy issued. But lawyers like us have been pushing and pushing the intermediary authorisation boundaries a lot, and I think ASIC's sort of come to the view now that they think it's gone too far as well. So,
sorry, they notice as well for limited authorisations for accounts. This is part of this push as well.
No, although with limited authorisations for accountants, really briefly, if you're an accountant with a public practicing certificate, you can just go off and apply for and get a limited licence, and that allows you to do a limited number of activities. One of those activities is to help somebody set up a self-managed super fund, and to do that, ASIC formed the view that an accountant needs an authorisation not only to give advice about a self-managed super fund, but also to arrange to issue. And arranging to issue is a subset of issue. It's act as an agent for an issuer, and I think the view that ASIC formed in that situation was when an advisor or an accountant helps their client set up an SMSF trustee, and then it issues interest in the SMSF to its members, it's sort of arranging for the trustee to issue. And so that's a bit of a different situation, and I don't think the legal problems around that we're talking about, where a product issuer wants to basically delegate their product issuer rights to a third party, I think that's a different situation. Yeah.
So if you're a peer-to-peer lender, if you're running a platform, ASIC's going to virtually insist that you have a licence. And I certainly wouldn't advise anyone to try and do that under an AR model. If you're in the robo-advising or investing space, it's a bit different. And the question really is, does your product have an element of discretionary trading? Can you discretionary trade on investors' behalf? If you can, and that can be as simple as rebalancing portfolios, you're running what's called a managed discretionary account service, and you need to be licensed in that respect. Now, there's two models on that. That's sort of a bipartite model where you deal directly with the client, or a tripartite model where there's an operator, an MBA advisor, and the client. The operator needs to have a licence. The advisor, who's typically, say, a financial planner, who'll be setting the investment portfolio and the asset allocation under a traditional financial planner model, he would be the manager. He typically would be an authorised representative, and then obviously to do the bipartite model, then you need to be licensed for the full thing. So we've had experience with a number of robo-advising investing businesses, and it's some have gone the AR model, some have gone with the full licence model. Depends really on how quickly you want to get to market, and probably the big issue is, do you have responsible managers to get your licence, which is probably the biggest issue with licensing and fintech. And the issue arises out of one of the licence conditions, which is that you must, as a licensee, be able to show you have competence to provide financial services. And the way ASIC interprets that is you show competence through the responsible managers that you appoint into your business. And it's based on a model of you get people who've got experience in working in the industry, and you go and set up your business. You get those people in with experience to help you start up a business. So it sort of perpetuates the old order. It just keeps reinvigorating the old order of things. That doesn't really work when you start getting innovative areas like fintech, where ASIC's basic requirement is you have people who've got 3 years experience in the last 5 providing those services. How do you find those people when you're setting up a completely new business and a new business model from scratch? This has been an issue with every fintech client we've worked with. And it's an area that ASIC just won't give you any ground at all. They recognise it's a problem. We've approached them a couple of times now to try and get some sort of relief or a bit of wiggle room, if nothing else, on RM experience, and it's just something they won't give you any ground at all. So the problem is you've got to go try and find someone out there who can give you that experience. As Megan's pointed out, a completely new thing coming in like crowdsourced equity funding. How do you find people who've got any experience at all in it? It's ridiculous. So this is an area Megan's really on the coalface on. Do you want to make any few points, Megan, on RMs?
Yeah, I suppose the important thing is that when we're talking about licensing for businesses like robo-advice or marketplace lending or anything like that, essentially what these businesses have to do is there's no financial services license that says you can operate a robo-investing platform. It is, these businesses are falling within the existing categories of financial product and service, and therefore it's ASIC's view that no matter how new and innovative your business model, if you are fitting into one of these existing categories, you should be able to find someone with experience in that existing category, which occasionally can mean that you need, in order to find someone with the right experience, fintech businesses are having to go out and identify people in areas that seem at first blush really quite different to the business that they're proposing to operate. But in ASIC's view and legally, because they fall within the same bucket of financial product or service, that is the type of person you need to have to satisfy ASIC that your responsible managers are competent. ASIC has an incredibly strict view of the types of experience and the types of people it considers to be competent. Essentially, and look, we work with a lot of people trying to get licences, and literally the way we do it for our clients is we sit down with the type of licence they're going for, and we sit down with all their proposed responsible managers, and for each financial product or service on your licence, you must have at least one person that has ticked off that exact product or service for at least 3 years under another financial services licence. And it is that technical. I've in the past had arguments with ASIC where someone falls 2 months short and of 3 years, and they will go and count the weeks, and they will go back and check the licence of every legal word to make sure that the authorisations of the licence you worked with back then match what you want to get now. As David said, they've been very reticent thus far to provide any sort of accommodation. Pretty much every fintech liaison meeting with ASIC or any discussion around licensing and innovative businesses, this is by far one of the biggest issues that people in the marketplace are facing. And thus far, ASIC's essentially said, yeah, look, we know it's an issue, but good luck. There hasn't been any movement to provide any sort of relief for new businesses. But look, as I said, with the new crowdsourced equity funding legislation, I think they're going to have to consider how to enact that. They won't be able to say you need to find someone with 3 years' experience at a crowdsourced funding intermediary, because those people won't exist. So I think we're hopeful that that process will enable some form of relief to other innovative businesses. And the other thing I just want to touch on really briefly while we're talking about licensing is ASIC has come out quite publicly and has had a lot of interaction with the industry. The chairman and other commissioners are quite active in promoting innovation. There's a new innovation hub with ASIC that they are encouraging fintech businesses and other new entrants to the industry to interact with. I suppose it does appear to be a useful resource for people at a very particular point in the business cycle. ASIC won't deal with you through the innovation